The US dollar index has officially slipped below 100, a signal that global confidence in the greenback is eroding. While the Fed continues to hold interest rates steady, markets are starting to price in a pivot. But it's not only inflation expectations or soft CPI numbers driving this shift. Something deeper is at play. At the same time, the yield on the 10-year US Treasury has jumped above 4.5%. Investors are selling long-term government bonds, a sign of uncertainty, perhaps even distrust. Normally, falling inflation and a weakening dollar would push yields lower. Instead, yields are rising. Behind this contradiction lies a broader fear that the U.S. government's debt path is no longer sustainable. Foreign demand for treasuries is weakening, especially as trade tensions escalate. China, in particular, may be quietly stepping back. In response to new U.S. tariffs, Beijing has raised import taxes on American cars to 125%. But the real message lies not in the numbers. It's in China's statement that there will be no further retaliation. Not because tensions are cooling, but because tariffs have become symbolic. Economic countermeasures are shifting into the realm of currency policy and reserve management. President Xi Jinping, speaking alongside the Prime Minister of Spain, emphasized that no one wins a trade war, a clear signal that China is positioning itself as the voice of reason on the world stage, while the U.S. appears increasingly isolated. In the background, Europe is also making moves. A Swedish lawmaker has proposed adding Bitcoin to the country's foreign reserves, citing U.S. policy under Trump that allowed confiscated digital assets to be repurposed into national holdings. Bitcoin is gaining credibility as a strategic reserve asset, just as the Eurozone accelerates its development of a digital euro. While the U.S. remains divided on crypto policy, others are preparing for a post-dollar world. Amid all this, recent U.S. economic data paints a mixed but potentially hopeful picture. CPI is down, core PPI is cooling, and even rental inflation is easing, one of the stickiest components of the inflation basket. These are signs that the fight against inflation may be turning a corner. But the Federal Reserve remains trapped. With inflation slowing, pressure is mounting to cut rates. Yet with yields high and political instability rising, any sudden move could trigger new market volatility. And as central banks around the world begin to shift strategies, the Fed is watching, waiting, and increasingly alone. So while headlines focus on tweets and tariffs, the real story may be this: the global monetary order is quietly shifting. The battle is no longer just between Washington and Beijing, it's between the past and the future of global finance. And the next move may not come from a politician, but from a central bank.
So, what do you think about this take? Drop a like and share if you find it insightful, and don't forget to subscribe for the latest updates.